Corporate finance. Corporate finance is the area of finance dealing with the sources of funding and the capital structure of corporations, and the actions that managers take to increase the value of the firm to the shareholders, as well as the tools and analysis used to allocate financial resources. The primary goal of corporate finance is to maximize or increase shareholder value. Although it is in principle different from managerial finance, which studies the financial management of all firms rather than corporations alone, the main concepts in the study of corporate finance are applicable to the financial problems of all kinds of firms. Investment analysis, that's also called capital budgeting, is concerned with the setting of criteria about which value-adding projects should receive investment funding, and whether to finance that investment with equity or with debt capital. Working capital management is the management of the company's monetary funds that deal with the short-term operating balance of current assets and current liabilities. The focus here is on managing cash, inventories, and short-term borrowing and lending, such as terms on credit extended to customers. The terms corporate finance and corporate financier are also associated with investment banking. The typical role of an investment bank is to evaluate the company's financial needs and raise the appropriate type of capital that best fits those needs. Thus, the terms corporate finance and corporate financier may be associated with transactions in which capital is raised in order to create, develop, grow, or acquire businesses. Recent legal and regulatory developments in the US will likely alter the makeup of the group of arrangers and financiers willing to arrange and provide financing for certain highly leveraged transactions. Financial management overlaps with the financial function of the accounting profession. Financial accounting is the reporting of historical financial information, while financial management is concerned with the allocation of capital resources to increase a firm's value to shareholders. Outline of corporate finance. The primary goal of financial management is to maximize or to continually increase shareholder value. Maximizing shareholder value requires managers to be able to balance capital funding between investments in projects that increase the firm's long-term profitability and sustainability, and paying excess cash in form of dividends to shareholders in the short term. Managers of growth companies, that is the firms that earn high rates of return on invested capital, will typically use most of the firm's capital resources and surplus cash on investments and projects so that the company can continue to expand its business operations into the future. When companies reach maturity levels within their industry, managers of these companies will use surplus cash to pay out dividends to shareholders. Managers must do an analysis to determine the appropriate allocation of firm's capital resources and cash surplus between projects and payouts of dividends to shareholders, as well as paying back creditor-related debt. Choosing between investment projects that will be based on several interrelated criteria. 1. Corporate management seeks to maximize the value of the firm by investing in projects which yield a positive net present value when valued using an appropriate discount rate in consideration of the risk. 2. These projects must also be financed appropriately. 3. If no growth is possible by a company and excess cash surplus is not needed either, then financial theory suggests that management should return some or all of the cash to shareholders via dividends. This capital budgeting is the planning of value-adding long-term corporate financial projects relating to investment funding through and affecting the firm's capital structure. Management must allocate the firm's limited resources between competing opportunities, that is projects. Capital budgeting is also concerned with the setting of criteria about which projects should receive investment funding to increase the value of the firm and whether to finance that investment with equity or with debt capital. Investment should be made on the basis of value added to future of corporation. Projects that increase the firm's value may include a wide variety of different types of investments, including but not limited to expansion policies, mergers, and acquisitions. When no growth or expansion is possible by a corporation and excess cash surplus exists and is not needed, then management is expected to pay out some or all of those surplus earnings in the form of cash dividends or to repurchase the company's stock through a share buyback program. Capital structure. Achieving the goals of corporate finance requires that any corporate investment be financed appropriately. The sources of financing are generically capital self-generated by the firm and capital from external funders, obtained by issuing new debt and equity or hybrid or convertible securities. As above, since both hurdle rate and cash flows will be affected, the financing mix will impact the valuation of the firm. There are two interrelated considerations here. 1. Management must identify the optimal mix of financing, that is, the capital structure that results in maximizing firm value. Financing a project through debt results in a liability that must be serviced, thus entailing cash flow implications independent of the project's degree of success. Equity finance is less risky with respect to cash flow commitments, but results in a dilution of share ownership, control, and earnings. The cost of equity is also typically higher than the cost of debt, which is additionally a deductible expense, and so equity financing may result in an increased hurdle rate, which may offset any reduction in cash flow risk. 2. Management must attempt to match the long-term financing mix to assets being financed as closely as possible in terms of both timing and cash flows. Managing any potential asset liability mismatch or duration gap entails matching the assets and liabilities according to maturity pattern or duration. Managing this relationship in the short term is a major function of working capital management. Other techniques such as securitization or hedging using interest rate or credit derivatives are also common. Much of the theory that is presented here falls under the umbrella of the trade-off theory, in which firms are assumed to trade off the tax benefits of debt with bankruptcy cost of debt when choosing how to allocate the company's resources. However, economists have developed a set of alternative theories about how managers allocate a corporation's finance. One of the main alternative theories of how firms manage their capital funds is the pecking order theory, which suggests that firms avoid external financing while they have internal financing available, and avoid new equity financing while they can engage in new debt financing at reasonably low interest rates. Also, capital structure substitution theory hypothesizes that management manipulates the capital structure such that earnings per share are maximized. An emerging area in finance theory is right financing, whereby investment banks and corporations can enhance investment return and company value over time by determining the right investment objectives, policy framework, institutional structure, source of financing, and expenditure framework within a given economy and under given market conditions. One of the more recent innovations in this area, from a theoretical point of view at least, is the market timing hypothesis. This hypothesis, inspired in the behavioral finance literature, states that firms look for cheaper type of financing regardless of their current levels of internal resources, whether debt or equity. Sources of capital. 1. Debt capital. Corporations may rely on borrowed funds as sources of investment to sustain ongoing business operations or to fund future growth. Debt comes in several forms, such as through bank loans, notes payable, or bonds issued to the public. Bonds require the corporation to make regular interest payments on the borrowed capital until the debt reaches its maturity date. Thereby, the firm must pay back the obligation in full. Debt payments can also be made in the form of sinking fund provisions, whereby the corporation pays annual installments of the borrowed debt above regular interest charges. Corporations that issue callable bonds are entitled to pay back the obligation in full whenever the company feels it's in their best interest to pay off the debt payment. If the interest expenses cannot be made by a corporation through cash payments, the firm may also use collateral assets as a form of repaying their debt obligations, or through the process of liquidation. Equity capital. Corporations can alternatively sell shares of the company to investors and raise capital. Investors or shareholders expect that there will be an upward trend in the value of the company over time to make sure investment is a profitable purchase. Shareholder value is increased when corporations invest equity capital and other funds into projects that earn a positive rate of return for owners. Investors prefer to buy shares of stock in companies that will consistently earn a positive rate of return on capital in the future, thus increasing the market value of the stock of that corporation. Shareholder value may also be increased when corporations pay out excess cash surplus in the form of dividends. Preferred stock. Preferred stock is an equity security which may have any combination of features not possessed by the common stock, including properties of both an equity and a debt instrument, and is generally considered a hybrid instrument. Preferreds are seniors to common stock but subordinate to bonds in terms of claims to the assets of the company. Preferred stock usually carries no voting rights but may carry a dividend and may have priority over common stock in payment of dividends upon liquidation. Similar to bonds, preferred stocks are rated by the major credit rating companies. The rating for preferreds is generally lower, since preferred dividends do not carry the same guarantees and interest payments from bonds, and they are junior to all the creditors. Preferred stock is a special class of shares which may have any combination of features not possessed by a common stock. The following features are usually associated with preferred stock only. 1. Preference in dividends. 2. Preference in assets in event of liquidation. 3. Convertibility to common stock. 4. Callability at the option of corporation. 5. Non-voting. Investment and project valuation. In general, each project's value will be estimated using a discounted cash flow, that is DCF valuation, and the opportunity with the highest value, as measured by the resultant net present value (NPV), will be selected. This requires estimating the size and timing of all the incremental cash flows resulting from the project. Such future cash flows are then discounted to determine their present value. These present values are then summed, and the sum of initial investment outlay is the NPV. The NPV is greatly affected by the discount rate. Thus, identifying the proper discount rate, often termed as hurdle rate, is critical to choosing good projects and investment for the firm. The hurdle rate is the minimum acceptable return on an investment, that is the project appropriate discount rate. The hurdle rate should reflect the riskiness of the investment, typically measured by volatility of cash flows, and must take into account the project relevant financing mix. Managers use models such as the CAPM or the APT to estimate a discount rate appropriate for a particular project, and use the weighted average cost of capital, that is WACC, to reflect the financing mix needed. A common error in choosing a discount rate for a project is to apply a WACC that applies to the entire firm. Such an approach may not be appropriate where the risk of a particular project differs markedly from the firm's existing portfolio of assets. In conjunction with NPV, there are several other measures used as secondary selection criteria in corporate finance. These are visible from DCF and include discounted payback period, IRR, modified IRR, equivalent annuity, capital efficiency, and ROI. Alternatives to NPV include residual income valuation, MVA, EVA, and APV. Valuing flexibility. In many cases, for example in R&D projects, a project may open or close various paths of action to the company, but this reality will not be typically captured in a strict NPV approach. Some analysts account for this uncertainty by adjusting the discount rate, that is by increasing the cost of capital, or the cash flows, using certainty equivalents or applying haircuts to the forecast number. Even when employed, however, these later methods do not normally properly account for changes in risk over the project's lifestyle, and hence fail to appropriately adapt the risk adjustment. Management will therefore sometimes employ tools which place an explicit value on these options. So, whereas in a DCF valuation, the most likely or average or scenario-specific cash flows are discounted, here the flexible and staged nature of investment is modeled, and hence all potential payoffs are considered. The two most common tools are decision tree analysis (DTA) and real options valuation (ROV), and they are often used interchangeably. 1. DTA. DTA values flexibility by incorporating possible events and consequent management decisions, and outsource production otherwise. In turn, given further demand, it would similarly expand the factory and maintain it otherwise. In a DCF model, by contrast, there is no branching. Each scenario must be modeled separately. In the decision tree, each management decision in response to an event generates a branch or a path which the company could follow. The probabilities of each event are determined by specified by the management. Once the tree is constructed, 1. All possible events and their resultant paths are visible to management. 2. Given this quote-unquote knowledge of events that could follow, and assuming rational decision making, management chooses the branches, that is actions, corresponding to the highest value path probability weighted. And 3. This path is then taken as representative of project value. 2. ROV, that is real options valuation method. ROV is usually used when the value of a project is contingent on the value of some other asset or underlying variable. For example, the viability of mining project is contingent on the price of gold. If the price is too low, management will abandon the mining rights. If sufficiently high, however, management will develop the ore body. Again, a DCF valuation will capture only one of these outcomes. Hence, 1. Using financial option theory as a framework, the decision to be taken is identified as corresponding to either a call option or a put option. 2. An appropriate valuation technique is then employed, usually a variant on the binomial options model or a bespoke simulation model, while Black-Scholes type formulae are then used less often. 3. The true value of the project is then the NPV of the most likely scenario plus the option value. Quantifying uncertainty. Given the uncertainty inherent in project forecasting and valuation, analysts will wish to assess the sensitivity of a project NPV to the various inputs to the DCF model. In a typical sensitivity analysis, the analyst will vary one key factor while holding all other inputs constant, ceteris paribus. The sensitivity of NPV to a change in that factor is then observed and is calculated as a quote-unquote slope, that is delta NPV divided by delta factor. For example, the analyst will determine NPV at various growth rates in annual revenue as specified, usually set increments, that is minus 10%, minus 5%, 0%, 5%, and the series goes on. Often several variables may be of interest, and their various combinations produce a value surface or even a quote-unquote value space, where NPV is then a function of several variables. Using a related technique, analysts can also run scenario-based forecast of NPV. Here, a scenario comprises a particular outcome for economy-wide quote-unquote global factors, that is demand for the product, exchange rate, commodity price, etc., as well as for company-specific factors, that is unit costs, etc. As an example, the analyst may specify various revenue growth scenarios, for example 0% for worst case, 10% for likely case, and 20% for best case, where all key inputs are adjusted so as to be consistent with the growth assumptions and calculate the NPV for each. Note that the scenario-based analysis, the various combinations of inputs must be internally consistent, whereas for the sensitivity approach, these need not be so. An application of this methodology is to determine an quote-unquote unbiased NPV, where management determines a subjective probability for each scenario. The NPV for the project is then probability weighted average of the various scenarios. A further advancement which quote-unquote overcomes the limitations of sensitivity and scenario analysis by examining the effects of all possible combinations of variables and their realizations, unquote, is to construct stochastic financial models, as opposed to the traditional static and deterministic models as above. For this purpose, the most common method is to use Monte Carlo simulation to analyze the project's NPV. Sorry, it is Monte Carlo simulation. This method was introduced to finance by David B. Hertz in 1964, although it has only recently become common. Here, the cash flow components are heavily impacted by uncertainty, are simulated, mathematically reflecting their random characteristics. In contrast to the scenario approach above, the simulation produces several thousand random but possible outcomes or trials, covering all conceivable real-world contingencies in proportion to their likelihood. The output is then a histogram of project NPV, and the average NPV of the potential investment is then observed. This histogram provides information not visible from the static DCF. For example, it allows for an estimate of the probability that the project has a net present value greater than 0. Continuing the previous example, instead of assigning 3 discrete values to revenue growth and to other relevant variables, the analyst would assign an appropriate probability distribution to each variable, commonly triangular or beta, and, wherever possible, specify the observed or supposed correlation between the variables. These distributions would then be quote-unquote sampled repeatedly, so as to generate several thousand random but possible scenarios, with corresponding valuations, which are then used to generate the NPV histogram. The resultant statistics, that is the average NPV and standard deviation of NPV, will be a more accurate mirror of the project's randomness than the variance observed under the scenario-based approach. These are often used as estimates of the underlying spot price and volatility for the real option valuation as above. A more robust Monte Carlo model would include the possible occurrence of risk events that drive variations in one or more of DCF model inputs.